Here's a truth most Singapore investors never stop to think about. Dividends from DBS, OCBC, and UOB are not free money. And they're definitely not a gift from the bank. Every payout actually contains a message that reveals the real state of the bank's business more clearly than earnings reports, analyst opinions, or stock price movements. And once you learn how to read that message, you'll understand why some Singaporeans build stable, predictable passive income year after year, while others get trapped chasing dangerously high dividend yields that eventually collapse. So stay with me till the end because I'm going to explain, in simple Singapore language, what bank dividends are really telling you, how to use that information to build cash flow freedom, and how to avoid painful dividend traps. Before we continue, do me a quick favor. Like this video so more Singaporeans can be reached, and subscribe to Wealth for You if you believe passive income should be simple, safe, and sustainable. Disclaimer: this video is strictly for education and entertainment. It is not financial advice. I'm not telling you to buy or sell any investments. Please always do your own due diligence before making any financial decisions. Chapter 1. What bank dividends really mean. A dividend is not generosity, it's a confession and a signal. When DBS, OCBC, or UOB pay dividends, they're not saying, "Here's some free money, please be happy with us." What they're actually saying, without using words, is this: we earned real cash. We don't currently have a better way to grow every extra dollar inside the business, so we're returning the excess cash to you, the rightful owner. And that statement carries three powerful truths. The business is profitable, the cash flow is real and recurring, and the banks don't need to hoard every dollar just to survive or grow. So dividends are not a bonus or a reward. Dividends are a financial message, a message from the business telling you exactly how healthy it really is. Chapter 2. The Truth Serum of Corporate Reporting. Here's something most investors never realize. You can dress up earnings, but you can't dress up dividends. Companies can make profits look better by counting future income early, hiding expenses under different labels, massaging numbers to boost results, or calling recurring problems one-time issues. But dividends are different. Dividends are real cash leaving the business and going into your pocket. And you can't fake that for long. So when DBS, OCBC, and UOB declare a dividend, they're making a promise. We will continue generating this level of cash, quarter after quarter. If they can't keep that promise, dividends get cut, confidence collapses, and the share price reacts instantly. No excuses, no PowerPoints, no fancy wording can hide it. That's why seasoned income investors trust cash over accounting. Earnings can be adjusted. Stock prices swing with emotion, but dividends tell the truth. When a bank pays steady and growing dividends, it's sending a loud message. Our business is real, strong, and consistently profitable. For Singapore investors, especially those planning around monthly bills, kopi money, lifestyle spending, or retirement, that honesty and predictability are priceless. Chapter 4. Why DBS, OCBC, and UOB are dividend machines. Not every company is meant to pay dividends. High-growth companies should keep their cash to reinvest and expand. Mediocre companies hoard cash and waste it on bad decisions instead of rewarding shareholders. The sweet spot is the mature, profitable business, strong, stable, and no longer needing every dollar to grow. For these companies, the smartest and most honest use of surplus cash is to pay dividends. That's exactly where DBS, OCBC, and UOB are today. They generate reliable loan and fee income, are already fully scaled across Singapore and the region, and don't need to hoard every dollar to survive or expand. So when the banks distribute profits, it's not weakness, it's maturity and discipline. DBS, OCBC, and UOB aren't dividend machines because they are nice. They are dividend machines because it is the most rational and value-creating thing their business model can do. Chapter 4. Why dividend reliability matters more than share price in Singapore. You know, Singaporeans don't invest just to feel rich on paper. We invest because we have real expenses every month. Bills, food, mortgage, parents' allowance, kids' needs. That's why, honestly, reliable dividends matter more than those daily price swings. When DBS, OCBC, and UOB pay dividends predictably, you receive real cash, not just paper gains. You can plan your expenses with confidence, and you don't panic when the market is red. Even when stock prices move up and down, the income keeps coming in. And that's what really matters for everyday life. Bank dividends especially suit Singaporeans because they're usually paid twice a year or quarterly. They grow gradually over time, and they support steady passive income, not speculation. Most investors lose money because they panic and sell when prices fall. But income investors stay invested because, well, price can drop. But my dividends are still coming. And staying invested, not reacting emotionally, is what builds long-term wealth. Dividend reliability equals financial peace of mind. Chapter 5. Why dividend growth creates real financial progress for Singaporeans. Most people obsess over dividend yield, but what truly builds wealth in Singapore is dividend growth. When dividends rise over time, your income grows faster than inflation. Your yield on original cost increases, and your portfolio pays you more without you working harder. Here's a simple example many Singaporeans will recognize. If you bought DBS at around $24 plus years ago, today you'd be receiving about $2.85 per share each year, including the capital return dividends. That's already more than 11% yield on your original cost. And if dividends continue to grow, your income will grow right along with it. That's a great example of dividend growth in action, but just a reminder. Past performance is not a prediction of future results. Dividend payouts can change depending on business and market conditions. That is real financial progress. Your investments start working harder for you, your income increases even if your salary doesn't, and you slowly move toward replacing part, or even all, of your monthly expenses. For many Singaporeans, this journey looks like first kopi money, then grocery money, then bill money and lifestyle money, and eventually retirement money, all without selling a single share. Dividend growth is like a built-in pay raise, not from your employer, but from your investments. Chapter 6. Why dividend income works especially well in Singapore. Dividend income fits Singapore life in a way few other strategies do. Here the cost of living is high, bills come every month, and most of us don't invest just to see our portfolio number go up. We invest because we need reliable cash flow. That's why dividends feel so powerful. They turn investing into income you can actually use. For many Singaporeans, the winning formula is simple. CPF Life, for baseline security, plus bank dividends for cash flow. CPF covers basic needs later in life, while dividends from banks like DBS, OCBC, and UOB grow over time, increasing your income even if your salary doesn't. We've all seen this story. Someone who picked up OCBC at roughly $13 years ago now receives about 98 cents per share annually, including special dividends. That works out to over 7.5% yield based on what they originally paid. That's how Singaporeans quietly build financial comfort. First kopi money, then grocery money, then bill money, and eventually retirement income, all without selling shares. Dividend income works here not because it's flashy, but because it is steady, practical, and built for real life in Singapore. Chapter 7. The Risks of Dividend Investing. Dividend investing is powerful, but it's not risk-free. Many investors get hurt because they chase the highest yield, thinking more income automatically means a better investment. In reality, extremely high yields often signal danger. The business is struggling, and a dividend cut may be coming. Even reliable dividend stocks can drop sharply in price during recessions or market shocks. Strong companies are not immune to volatility. They just tend to recover faster. The key is sustainability, not headlines. A 5% dividend that is safe and growing is far better than a flashy 9% yield that collapses later. Always look at payout ratio, actual cash flow, debt levels, and how the company behaved during past crises. And finally, don't put everything into one sector, even if the dividends look great. Banks and REITs are favorites in Singapore, but they move in cycles. Overconcentration means unnecessary risk. Dividend investing reduces drama and gives emotional stability, but it does not eliminate risk. Smart dividend investors stay selective, disciplined, and diversified. Final thoughts. Cash flow freedom, the Singapore way. Financial freedom isn't when your portfolio hits $1 million. Financial freedom is when your investments pay for your life, whether you work or not. CPF Life gives you baseline security. Dividends give you year-round cash flow. And when DBS, OCBC, and UOB start covering your kopi, groceries, bills, insurance, even family expenses, something powerful happens. Work stops being a necessity and becomes a choice. That is cash flow-rich living, the Singapore way to financial independence. If this video helped you understand the truth behind dividends from DBS, OCBC, and UOB, tap like so more Singaporeans can invest smarter and safer, and comment below. What will your dividend income pay for first? Kopi, groceries, bills, or travel? And subscribe to Wealth for You, helping Singaporeans retire with kopi money for life, stress-free.